Victor, it's been a crazy few months in the markets, and with the first half of the year officially in the books, I think it's a good opportunity to take a step back, see where we were, where we are, and take a quick look into some of the macro forces that are going to be shaping the next half of the year.
Yeah, I think that's great. I think it's good to kind of check in, see where you're at. Mid-year is a great time for that. It's just like internally we're reevaluating the portfolios, looking at, hey, do all of our holdings make sense? How are we positioning from here until the end of 2026? And so I think we can kind of start by taking a look back on how the market's done so far this year. I mean, performance has been pretty strong, although it hasn't been without its volatility. I mean, we saw, a decent start to the year, and then all of a sudden the Iran war hits. And then all of a sudden you kind of start getting past that. And then you've got AI news and other developments, and then a new Fed coming into office. And so I think it's good that we are going to discuss those things, kind of what happened, what we're looking forward to, or looking for, in the rest of the year. And I think, digging first into what we've seen so far, I mentioned good performance. I mean, we've seen, the S&P 500 up roughly 10%, pretty strong for, half of a year performance. The NASDAQ up a little bit more than that, around 13%. But what I really want to draw the attention to is something that you and I called out in our 2026 market outlook, and that is the theme of a broadening market, broadening beyond those huge mega cap names into the smaller stocks. And so that's where you see the equal weight S&P up 12% versus the S&P's 10. And then even more notably, the Russell 2000 up about 20% in the first half of the year. Pretty remarkable.
Yeah, it really is. And it feels like there's been something new every day, certainly every week so far this year. And, to still have market performance that good despite everything that we face is really positive. But I think that's a really important point that you draw on with the Russell 2000 is that broadening out, that a lot of the, mega cap names, your hyperscalers, your Mag 7 even, have been pretty stagnant this year. So when you have a large chunk of the market, especially such highly weighted chunk of the market that hasn't done very much, certainly not kept up with the market in a lot of cases, you see that broadening out, in the Russell 2000 especially, and even like you mentioned, S&P equal weight, you see that broadening out because a lot of those key companies are taking a while consolidating the gains that they've had over the last 3 years, but really not contributing a whole lot this year.
Yeah, I mean, you've seen such a mixed market dynamic where your traditional leaders or the companies that we were talking about in 24, 25, your Mag 7, if you will, I mean, they're not so much the leaders anymore. You've got these new emerging companies, some that were, smaller before, but have grown into sizable contributors to the broader indices. And that's why we like to be active managers. That's why we like to look at individual companies, invest in not just the S&P 500 or the broader index, because if you want exposure to those companies, you're not going to get it from an S&P 500 ETF or index fund. So I think that's been the exciting thing so far this year is, although we've been in the midst of a lot of, broader economic and market volatility, a lot of headlines, a lot of news, to a large extent, this market's been fundamentally driven, and you've seen a lot of that earnings performance come through in those smaller companies, which is driving that exactly.
Yeah, and you mentioned our 2026 outlook, but I want to, go back in time even further. In our 2025 outlook, for sure, we started talking about broadening out, and we saw it in 25 to an extent, and this is even a bigger extent where you have the Russell vastly outperforming the other indices. And so, I think this is maybe a little bit of a pat on the back to myself, to us, but it's, something we've been calling for a long time and seen it incrementally growing over time. It's not like we woke up one morning and this was the new, market situation where every is broad and smaller cap performance. This has been happening for a long time. Yeah, I think that's just something interesting to take a look back on and worth calling out here.
Yeah, and so I think that continues to some extent in the back half of the year, and we can kind of get into this in further podcasts and in commentary. And then we just released our Q3 market outlook, which provides some of that color and detail. And I think you might see some better performance from some of the mega caps, particularly some of the hyperscalers that have really lagged in this first half of the year. But I still think it's going to be a story of some of those smaller companies who are going to continue to push on the earnings front that are going to drive a lot of that performance. So I think that's very exciting. With that being said, I think it'd be valuable to just kind of hit a few of these hot topics, ones that we have covered before and, will continue to cover as long as they remain relevant. And first and foremost, let's get the Iran war out of the way. We did a podcast on this recently, but we've had some developments. Just like in our podcast, we did not expect this to immediately enter the rear view. And, lo and behold, we are out of the ceasefire now and strikes are happening again.
Yeah, and it seems like the parties at B, the world leaders, have tried the negotiation route and, come to the realization that at least whoever's speaking for the Iranians haven't been negotiating necessarily in good faith. And part of that's due to the just fractured leadership over there. And so I think you're running into more difficulties in the negotiating process than you would, a traditional government. But like you said, we're back at war. Ceasefire broke. Iran started hitting ships again in Hormuz. There is still traffic going through Hormuz, which is interesting to see. And despite that, oil prices haven't really spiked back up to wartime levels. And so that's going to be something really interesting to keep watching as we continue. But at least in the meantime, we're still not at overly elevated gas prices.
Yeah, I think you're not going to see a huge market reaction if oil stays in the 70 to kind of mid to low 80 type range, which is where we're trading right now. And to your point, ships are still traveling through Hormuz, and I think the U.S., whether they can get a deal out of Iran or not, they're going to force open the strait one way or the other. This is what I think a lot of people were pushing for from the get-go. They did their best to get a deal, didn't happen. Now you're reverting to plan A or plan B, whichever one you want to call that. And that's going to be the solution. So I doubt we see another ceasefire unless a deal is made. Then the deal will come and then the ceasefire will follow. But I don't think we're going to play this kind of cat and mouse game anymore. So it'll be interesting to see how that develops and, what that means. But I think the key point of that being that if ships are continuing to go through Hormuz, you won't see the spike in oil prices that we saw from prior months.
Yeah, and one thing that I want to reiterate from prior podcasts, multiple of them, is my assertion that corporate America finds a way. And I'm going to expand that to global oil markets in this case, because you're seeing a lot of additional creative ways of getting oil from production to market, whether that's more oil shipping out of America or a lot of these Gulf areas building pipelines. Saudi Arabia's improved upon their big pipeline that exits out of a different strait. You have other countries building new ports that can get on the outside of the strait where Iran can't really hit that. And so you have a lot of problem solving taking place. And so even if this becomes a sticking point, I think, and especially if it does become a sticking point, I think we'll see Hormuz as an oil corridor, its importance decrease over time as people find alternative routes to market.
Yeah, not to mention you've seen increased production from a lot of other areas in the world. Venezuela is coming back online. The U.S. is continuing to ramp production. You've got places like South America and other areas of the world that are ramping up production. And so they're going to start to offset some of that. It certainly takes time, but I think, every month we get away from the beginning of this war, it continues to be an easier situation rather than a more difficult one. I think most people around Wall Street, most investors feel pretty confident that there's going to be a long-term solution sooner rather than later. Otherwise, you would see a more adverse market reaction. I think we feel the same. And so I think most people are maintaining optimism that something is going to be sorted out in Hormuz.
Yeah, I agree. So moving domestically, the Federal Reserve, we also covered this. But Warsh had his first press conference, Senate hearing, kind of give us the lay of the land on what that situation currently looks like. And we got a new CPI report recently with some pretty encouraging numbers.
Yeah, so you just noted the important piece of that, and that's the most recent inflation report that we got. That CPI came in the lowest that inflation has come in 6 years. Of course, a lot of the headline inflation, which includes those volatile food and energy categories, a lot of that was driven by energy prices coming down, post what we thought was post-Iran war, really during the Iran ceasefire when oil dropped into the low $70 range. So a lot of that was reflected in the CPI, which meant that CPI was down 0.4% month on month on a headline level. But I think more importantly is what we like to look at as core inflation, excluding those food and energy categories that can be so volatile. Core inflation was flat month over month, which hasn't happened in a very long time. So investors were very enthusiastic to see that, because what we noted from that initial Fed meeting was Warsh's intention to get inflation back to the Fed's target. And we viewed that as fairly hawkish, but what we've been preaching for a long time on these podcasts, on our written commentary, what we've been sending out to clients, is that we feel like inflation has been rolling over, and particularly because shelter is such a large portion of consumer price inflation. Mm-hmm. That piece of it, if you look at spot market data, what houses are actually selling for in the US market, it's trended relatively flat to down over the past couple of years. Mm-hmm. And so we knew that that was on a lag when it came to the formal data. And so we've been expecting that to flatten out or even deflate to some extent. We finally saw that with shelter only raising 0.1% month on month. I think that trend continues, which is going to give the Fed much more bandwidth and really kind of keep a lid on any potential rate hikes from here, especially from here until the end of the year.
Yeah, and I think that's a really important thing to call out is the market's priced in over one rate hike before the CPI print. Coming off of Warsh's hawkish tone, like you mentioned, the market started pricing in rate hikes, which was the exact opposite of what we had been expecting, rate cuts further down the line. And so with this new CPI and hopefully a persistent rollover in shelter inflation, this is going to give them a lot more wiggle room to hold rates steady, or even take some other Fed policy measures that Warsh sees as prudent, but not necessarily feel this obligation to raise rates like you might if inflation continues on a high trajectory, which is kind of hard to argue against when oil prices are going up very quickly, even though it's headline inflation. It's stuff that the Fed tries to look through a lot, or those temporary shocks. But still the optics can push the Fed to hike rates. And I think this gave them a lot of wiggle room.
Yeah, I think it was on our last podcast or recent podcast. We talked a lot about demand pull versus cost push inflation, and how the oil price dynamic is really cost push rather than there being so much demand, and the Fed can't really impact that cost push as much. Well, we're kind of seeing that play out, and I think it'll be interesting to see, if we do have higher oil prices, obviously that's going to play into the calculus a little bit more again. But, they've stayed fairly under wraps so far, which I think is a positive indicator for where the broader inflation trajectory is going, how the Fed's reaction function. And so I think as we look into the second half of this year, we're maintaining our base case that we're not expecting any rate hikes, still probably not expecting any cuts. I think if one or the other were to happen, I think it's actually more likely to see a cut than a hike. Mm-hmm. But that's just from where we're standing right now. I think base case certainly that there's going to be no change in rates for the rest of the year.
I agree. And I think it's worth, mentioning that part of Warsh's ongoing expectations are an increase in productivity, particularly driven by AI. And so I think now is a good opportunity to move into that space. We've talked about AI at length on previous podcasts. There's a lot of different directions to take it. But Victor, what's changed, or, kind of give us a replay of where we're at right now?
Yeah, I mean, I think the irony is that that a lot has changed and not a lot has changed at the same time. You've seen a ton of, if you're talking about investing and trading, a ton of froth in the market. We've seen huge swings in volatility, especially in the semiconductor space and hardware and memory companies. And a lot of us, more technical than it is fundamental. When we're talking about fundamental, we're talking about, earnings, company dynamics, the health of revenue growth and things that are impacting the actual financials of the business. Technical being more on the trading side, what the stock price is doing and how market participants are trading in and out of the company, not so much to do with the actual company operations. And so most of recent price action has been more on that technical side. It's been a lot of people have been, over positioned in some of these AI names because of the growth that we've seen year to date and from last year. And, the unfortunate part about some of that positioning is that some individuals and institutions have taken on leverage, aka borrowing, in order to buy more of these stocks. Well, whenever you're borrowing to buy more, you have to maintain what's called margin, and it can just lead to, broader swings in these companies. Part of that is coming out of Korea. Korea, of course, has exposure. Their stock market is about 50% of it is, two names, is Samsung and SK Hynix, both, semiconductor and memory producers, and who are, critical companies in this AI infrastructure play. But a lot of Korean investors had taken on leverage, aka borrowed, to invest in these companies. Well, it meant great gains for a short period of time, but as soon as there's some stress, it can create larger pullbacks in those stocks. So all of that being said, a lot of the recent trading isn't because the outlook is fundamentally different for these companies, but there's been a lot of froth. Some of this leverage and repositioning, has led to excess volatility. Seems like it's starting to work its way out.
Yeah, I agree. Anytime you have lots of leverage put on, it will need to work itself out at some point. And so this is just kind of, unfortunately, the increased volatility is what you see when that happens. And I just want to take a minute and look at something you said there, is that half the Korean index is two companies in the same business line. So and people have been talking about how, concentrated the S&P has become because you have all these tech names at the very top. Well, that is a whole nother level of concentration that, most of us wouldn't even call an index at that point because half of it's in two names that are in one industry. And so I think that in and of itself also exposes you to some of these more technical events because they just trade so closely. All of that being said, earnings have continued to look fantastic. We expect them to keep moving that direction and try and stay focused through all the noise, through all of the volatility on the fundamentals of these companies, which look really good, what they're selling right now, and future growth expectations even better.
Yeah, and I think the important piece as far as what we're looking for in the second half of the year is hyperscaler capex. And when I say hyperscaler, I mean, Microsoft, Meta, Amazon, Google, Oracle, those companies that are really driving, the cash injection into a lot of these AI infrastructure companies, making sure that they maintain the outlook for spending in the out years. I don't think we're going to see much change for 2026, certainly, or really 2027, but it's whenever you start looking at 2028, 2029, 2030, what does spending look like from a data center, perspective? And I think, demand is still likely to be strong, but a lot of these companies haven't had the best share price performance over the last year. And so, making sure that they're also rewarding shareholders to some extent is going to be important. That's the number one thing that I think we'll be watching, especially through this, next wave of earnings season.
Yeah, seeing Meta in particular get a big boost in share price one day because they announced that they would start leasing out some of their excess data center capacity. Even though that seems like it's pretty marginal, they're still using a lot of it, the vast majority of it in-house for their own stuff. the market rewarded that. And so I think there's a lot of pressure built up by investors who want to see these companies start, bringing in some revenue, at least revenue, but especially bringing in some earnings to help offset all this CapEx. And so I think that's a big thing to watch, because if they're going to continue investing at these rates, they need to start seeing some return on that investment. And so that's a very important thing to watch.
Yeah, absolutely. Well, I think we covered, at least, for the hard hitting, high level topics. I think we hit those, the Fed, Iran, AI, covering those and just kind of giving, what we've seen and what we expect here into the end of the year. I think, putting a bow on all of this, and you mentioned it, is the fact that earnings have really driven the price appreciation in stocks so far this year. I think we always get nervous if you see price appreciation without commensurate earnings growth.
Absolutely.
Now you're seeing almost the opposite. You're still seeing price appreciation, but earnings growth is actually outpacing that, which means the fundamentals are getting stronger, your valuations are more attractive. And as long as earnings growth sustains what we've seen and kind of what is expected going forward, I think you can see good gains in the second half of the year as well. It makes me feel comfortable investing in a lot of these companies. And so, having a fundamentally driven market feels much better than something that's more technical, like I was mentioning earlier.
Absolutely. Excited to unpack that with you and our audience on the Beckonomics podcast going forwards. Excited to invest around those themes with you, Victor. Thank you.
Thanks, Honor.